All right, so I think let's get started. So again, I'm Eric Post. I'm an economist here at ITR Economics. I'm really excited to be here today to talk about your MTI report and some of the developments in the economy and in some of your markets. So just a quick little bit about me. I manage the reports and subscriptions teams that produce that MTI report. And so I am involved in it throughout the process and overseeing it before it goes out. So that's why I'm here today. And let's get right into it since we have 45 minutes here. So if you take a look at the news of late, one of the things that you will notice is that there is this tendency toward really dramatizing what is going on in the economy. And so we love this chart here that shows global freight costs. And it just shows what are these costs and how are they moving on a day-to-day basis. And so we're still seeing in the news a lot of headlines about how expensive it is to ship things, and that is absolutely true. But we're also seeing headlines that are talking about shipping costs still going up dramatically. And as you can tell from this chart here, that is simply not the case, right? We have a flattening trend in that line that has been in place for quite some time. And I wanted to start with this slide, not because it has any great significance in particular to you all, but just as an example of how we are beginning to see the business cycle shift. And so while we have come off of a really strong rebound coming out from the second quarter of 2020 in the economy and had a really robust rise, we're now at record GDP levels. We are at record retail sales levels. We are at record capital goods new orders levels. The rates of change are beginning to turn over, and we are beginning to see signs that we will be moving into the backside of the business cycle in 2022 and into 2023. And so as you're thinking about your planning, if I had one takeaway from today, it's really from this chart: don't let the past dictate how you're going to be planning for 2022, because we will be seeing a pretty different economic environment in November of 2022 than as we sit here today in November 2021. So just a quick note, if you have any questions, please feel free to unmute yourself at any point in this presentation. I'll be taking questions at the end as well, but I always love questions throughout. I imagine if you have a question, probably several other folks on the call have the same exact question as well. So please don't hesitate to jump in. So one of the themes that has been out there of late is this idea that we have a supply chain crisis. And we at ITR absolutely recognize that there is a significant pressure on the supply chain right now. But I think when we read articles in the news, they tend to focus exclusively on the supply side of the supply chain. And remember, the supply chain has two parts to it. There is the supply side, yes, but there is also demand. And so I'd like just to think for a second, if we had the same exact supply chain in terms of producing product that we have today, but instead of having double-digit rise in capital goods, double-digit rise in retail sales, really exceptional growth in the housing market and some other sectors as well, would we be in the same supply chain problem that we are today, predicament that we are today? And the answer to that, I think, is no. It's a function not only of some issues on the supply side of the supply chain, but it's also the fact that the supply chain is having to keep up with this incredibly robust demand. And so if you look at this chart, which shows world container throughput, you can pretty clearly see that we are seeing an increase in throughput. It's maybe flattened out a bit of late, but it's in a general rising trend. And you'd be hard pressed to say that we aren't increasing supply in the economy. It's just that that supply is inadequate, woefully inadequate, to meet the demand that is going on in the economy right now. So that's important for a couple of reasons, and most primarily is that we are going to see demand side pressures begin to abate a bit in 2022. And so that's going to have all kinds of repercussions, a lot of them very welcome. Right? Inflation is going to come down. We will see the supply chain loosen up a bit, and throughput as far as being able to meet demand is going to be better in 2022 than it's been here in 2021. And so I would just encourage you, as you think about that supply chain, you're taking into account the fact that it's a function of both supply and demand. So here's a look at container traffic by the top 5 ports here in the US. Long Beach and Los Angeles have been the ones that have made the news. And so we do have some general rise, again, flattened out a bit of late, but general rise in container traffic. And so we are seeing the economy responding to this supply chain crisis by increasing supply, generally speaking. It's just, again, it's not able to keep up with demand. And so how do we know that demand is going to soften next year? Well, if you look at our system of leading indicators, and I've plotted one of those there in green, and what I'm looking at is the Purchasing Managers Index, 112 rate of change. And all that is saying, let's look at the Purchasing Managers Index for the most recent month, and let's compare that to the same month 12 months earlier, 1 year ago. And so 1 month of data relative to that same month of data 12 months ago, that's what that 1/12 rate of change is. And you can clearly see there that the PMI is in a rate of change declining trend. That's signaling that we're going to see softening conditions in manufacturing. We're going to see softening conditions in things like copper prices, and that's the blue line. That blue line represents the most recent 3 months of data. That's why we call it a 3/12 rate of change. So those 3 months of data relative to the same 3 months 1 year earlier. And so what you can see if you look at that graph is that pretty clearly the green line and blue line roughly match up, first of all. And second of all, you can see that the green line extends forward in time relative to the blue line. Why is that? Well, what we did is we shifted the green line forward by 3 months. That's its lead time. You can see the label down there at the bottom. The PMI typically leads copper prices on a rate of change basis through the business cycle by about a quarter. And so all that means is the PMI rate of change movement is signaling that we are going to see decelerating rise in copper prices. So not that dissimilar from what we are already seeing taking place in freight costs. So that's really a theme or a thesis as you look out into 2022, is it's not just freight costs, it's not just copper prices, it's going to be a significant number of sectors of pricing that see disinflation, right, lower rates of inflation, or even mild contraction in certain cases, certain commodities, as 2022 develops, particularly in the latter part of the year. And so if you look at the CPI, Consumer Price Index overall, we will see lower rates of inflation in 2022 than in 2021. And if you look at the Producer Price Index, we'll even see that Producer Price Index flatten out, be relatively flat at the bottom of the cycle around the end of 2022. So let's take a look at some more leading indicator inputs. We want to make sure that that Purchasing Managers Index for the US wasn't a one-off. Well, it's not. The JP Morgan Global Purchasing Managers Index, so this is looking outside the US at the world as a whole, is also in a downward trend. We can see that in lots of other leading indicators as well. If we look at the OECD +6 leading indicator, that's not charted here, but that's looking at all the OECD countries plus the 6 biggie economies that are not part of the OECD. So your China's, your India's, right? Those big economies, Brazil, for example. vast majority of the world, if you look at that leading indicator, it is in a declining trend. And so that's signaling that we will see those demand side pressures begin to abate a bit come next year. Now, I just want to take a moment to stop. When I talk about demand side pressures abate and slowing growth next year, people tend to get noticeably antsy because we like accelerating growth better than we like slowing growth. And of course, that's true. But 2022 is not going to be a year of slowing growth in the bad sense. It's going to be a year of realignment between supply and demand. So if you think of that really rise that we've seen in container throughput, it just has been the case that it hasn't been enough to keep pace with demand. It's not that it's not rising, it's not that it's in trouble. And so in 2022, we're just going to see that begin to normalize. And so 2022 is an economic year to be afraid of. It's just a year where things begin to sync back up, supply and demand with one another after this pandemic cycle that we had here in 2020 and in 2021. All right, well, let's take a look too at another part of the world, China. China is a very significant consumer of copper. About half the world's copper gets consumed in China. And you can see rate of change descent there as well in that green line. Now that's about a 4-month leading indicator to copper prices, that blue line again. And so when you have multiple leading indicators, the Purchasing Managers Index, the global PMI, the China leading indicator, that US OECD +6 leading indicator I mentioned, all these indicators pointing in the same direction, we can be confident that our forecast for decelerating growth in 2022 is correct. We can be confident in our forecast for disinflation next year is correct. We can be confident in our forecast for lower rates of rise in commodities like copper is correct. So just in terms of what's going on in some other key markets, if you look at non-residential construction, that is there in blue. That's the most recent 12 months of data relative to the 12 months prior to that. And then projected forward on that graph by 25 months is housing starts. And so this is a sector in the economy where in 2022, we're going to have a switch happen. Right, 2020, 2021 have been really strong years for single family housing. They've been tough years for non-residential construction. We're going to see the reverse of that happen. We're already seeing signs that housing starts are cooling. You can see that green line begin to move lower. But what that means is that all of those houses that have already been started, they're going to need non-residential buildings to meet the consumer demand. And so that those non-residential buildings typically take place later, right, after the single family ascent, after the economic accelerating growth of 2021. That's going to benefit non-residential construction down the road. And so you can see our forecast there with the blue dots going off the upper and lower bounds of the forecast range there, going off into 22, 23. So it's going to be some very nice years here for non-residential construction in the years to come. So what's one thing that we hear a lot of in people's anxiety closet? Well, one of them is government spending. And so if you look at government spending, I believe you saw this slide last quarter, but you can see a similar story this quarter, but a bit updated. Transfer payments, that red line, have begun to come down a little bit, but they are still way, way, way above where current tax receipts are there in blue. And so we all know the government is running high deficits. And that's not a political point. We're an apolitical organization here. It's run deficits under the Democratic administration here. Today, it was running deficits under the Republican administration. It's not a political point. It's just to point out that the government is spending a lot of money and people are pretty nervous about that fact. And so we hear sometimes like, oh, is this inflation and deficit spending, is that going to cause a recession right around the corner? And I want to put that out of your anxiety closet for right now. That's a future issue down the road. And the good news is the consumer is in an incredibly strong position here in the US. They have high savings, they have high disposable income. And so they are in a great place to spend more in the future. The labor market is strong, wage increases are strong. And so that inflation problem, the deficit problem is building, but it is not going to break the economy for the next several years. So you can put that out of your anxiety closet for the next couple of years. That anxiety, though, can begin to come back in what we think is going to be a recession around 2026, and then a significantly worse recession, a depression in the 2030s. And so that's really a function of demographics. We'll see baby boomers drawing on Social Security and healthcare at that time, and we'll see inflation rates higher and taking away, eroding at that consumer purchasing power at that time. But that's a long-term development. It's not a development for the next several years. And so what's important is to be getting out there and making sure you have what you need to grow your business. So taking a look here at inflation and bond yields, if you look at bond yields there, the 10-year is at 1.6% right now, very, very, very low relative to what we have grown accustomed to. Inflation is pretty high. And so it does not take a genius here to figure out that this is not a sustainable gap between bond yields and inflation. And so there's a couple of things, though, that you can do to take advantage of it right now. One is if you know that inflation is a longer term problem and there's growth ahead, not only for MTI, but also for the economy and the key verticals that MetalTree can go into, that you can see that it's a great time to be investing in your future. If you need capital equipment, if you need a building, if you need something where you can lock in a long-term interest rate or take advantage of some short-term rates, interest rates are going to be low for the next couple of quarters. It's a great time to be borrowing if you can get that fixed rate and be building out what you need for the future, because a recession is absolutely not right around the corner. So in terms of inflation, though, this chart, I looked at this same chart from last quarter as well, and I wanted to show you how the dots here have begun to move forward closer to 2021 and especially 2022. And so as we've watched this from quarter to quarter to quarter, last time you would have seen 3 little dots in the upper hand part of 2022 here. 2 little dots. Now we're already up to 3 dots here in 2022, and the dots keep shifting closer in time. And that's just a recognition by the Federal Reserve that inflation is stickier than perhaps they had once thought, that inflation is going to be a bigger problem to deal with, how robust the economic recovery is. And so we're going to need to see interest rates rise a little bit sooner than, say, the Federal Reserve was expecting a couple of quarters ago. Again, that's a longer term problem. Significant interest rate rise is not right around the corner, but it is something to be taking into account. It's a great time now to be investing in your business. The one other effect that this government spending has, though, is that it breeds inflation and it breeds a weaker dollar. And so if you look here at the deficit spend here in green, that's your 3-month moving average for that. And then the valuation of the dollar in blue, 3-month moving average of that. And those tend to move together. We're at kind of a disconnect right now where we have actually a pretty strong dollar relative to how much government spending there is going on. Our expectation is the blue line will come down to meet the green line, not the other way around. And so as we look off into the longer term future for this decade, generally we're going to be expecting a weakening dollar. And along with that is going to be some markets internationally that open up that maybe weren't available to US companies in the last decade. It's also going to mean that reshoring is going to be more popular than perhaps it would otherwise be with a really strong dollar. So a longer term issue to take into consideration there. All right, let's take a quick look at the macroeconomy. Now we're looking at 11 out of our 12 key leading indicators are in decline. You'll notice there they're in an orange color. that orange color signifies what we call the slowing growth phase of the business cycle. So the declines in these leading indicators isn't something to be overly alarmed at, as I was mentioning earlier. It just means that we're not going to see the rates of rise that we've had here in 2021 persist into 2022 for most markets. Non-residential construction, again, will be one of those that bucks that trend. Oil and gas is going to buck that trend, but most markets are going to see higher growth rates in this year than they will in 2022, a couple of them the reverse of that. So here's our outlook, that non-recessionary outlook I was mentioning earlier for GDP. Again, we've recovered completely from the shutdowns of 2Q20 there. You can see that robust rise. And now we're beginning to see that rise flatten out a little bit into a more normal trajectory. And indeed, that's going to be the case into about the middle of 2023. We'll see slowing growth in real GDP. Not a big, it's still going to be very healthy rates of rise. It's just going to be at a bit of a slower pace. And then we'll see in the back half of 2023 that accelerating growth pick back up again. But no recession through 2024. That's our outlook. In terms of retail sales, I mentioned earlier, it's growing at a double-digit clip. You can see year over year, it's 15.9%. So the most recent 12 months over the 12 months prior to that, that's in the green line on the upper panel of your screen. You can also see the data trend rise, that 12-month moving total is the green line on the bottom panel of your screen. And that's already at $7.1 trillion and just a dramatic recovery. You can see the shutdowns there and then just a real spike coming out of those shutdowns. Really, really strong consumer. And some people ask, is this just driven by inflation? And the answer to that is no. It's not just driven by inflation, it's also increasing volume. So a really strong consumer right now. We are seeing signs, though, that slowing growth will be the reality for the retail sector next year. You can see in the top panel in the gray line is the 3/12 rate of change. That's your most recent 3 months of retail sales relative to the same 3 months a year ago. That now has passed below your 12/12 rate of change. And so what that means, that's an ITR checking point that just means we're going to see some softening in those growth rates. And that's just a mathematical reality. We can't grow at 15.9% ad nauseum for consumer spending. That's just not possible. So some moderation in that is just to be expected. It's not something to be overly concerned about, just something to plan for. Capital goods, much the same story. Non-defense capital goods specifically, right now it's up 13.4% year over year. On a quarter relative to that same quarter a year ago, it's up 16.5%. But that 3/12 rate of change, quarterly rate of change, is beginning to move lower. And so that's going to signal some softening for 2022 and 2023 as well. But very, very healthy level of non-defense capital goods new orders coming in. The real challenge is meeting that demand. And so now we're switching away from those demand indicators of retail sales and of orders and looking at what can we actually produce. And if you look at production, it's only up 3.3% year over year. And if you look at the bottom hand panel of the screen, you can see we're not really that close to recovering from the pandemic, let alone where we were prior to the mild declining trend that we were in going into the pandemic. So we're not at record levels yet. That's going to take into 2023 for production. But we will see that recovery continue to occur as the supply chain untangles and we see rise continue on throughout there. All right. The number one issue that we've been dealing with here in this cycle that we hear over and over and over and over, no matter who you are, what industry you're in, is the jobs shortage. And I think this chart really gets at the heart of why this is such a problem. If you look at the 12-month moving average for job openings in orange, it's at 7.6 million. And employment, 12-month moving averages at 122.9 million. if you let your eye drift toward the left part of the screen, you can see that normally those blue and orange lines aren't that far away from one another, right? They tend to be relatively right on top of each other until the pandemic happens. And look at the gap in the vertical space between openings in orange and employment in blue. That's what's going on right now. We have way too many openings relative to workers. That's a function of many things. It's a function of demographics. It's a function of the skills that workers have are not the skills that workers want to hire for. It's a function of childcare costs. It's a function of safety concerns. Many, many things are going into this problem. And of course, the consequence is not only difficulty finding the workers that you want, but also paying them enough and retaining the ones that you already have. And so that's putting upward pressure on wages. And so if you look at wages for wholesale trade, they're up 3.8% over the last 12 months at $33.70. If you look at construction, it's $33.48, up 5% over the last 12 months. Manufacturing just ticked up over $30 an hour and is up 4% over the last 12 months. And if you look at those 5-year averages, clearly, we are outstripping those comfortably. Comfortably is probably not the word most employers would use right now. It is not a great situation. And so what can you do about this? I think the most important thing to do is to recognize that you can do something about this. You can't change demographics. You can't change a skills mismatch, but you can do things like look at your pay, make sure it's competitive. You can make sure that you're investing in capital equipment and making sure that your need for labor is as little as possible, especially with those low interest rates I showed earlier. And those things take money. And so, a lot of what we hear when we say those things from companies is, well, we've already automated everything and we're paying the wages that we can. There are a lot of other things you can do too. People leave managers, they leave firm cultures. You have to make sure your managers are really well trained. You have to make sure your firm culture is great. You have to make sure that those new employees, those Gen Z and those millennial workers can see a future at your company. They're not going to be content to work for you week to week to week. They want to see a future. You have to paint that future for them. And so making sure that they have the support they need, the mentoring they need, they understand their career path is a really important issue as well. And then the last thing is just work-life balance. Do you make sure that you know what your workers are valuing and you're doing what you can to make sure they have a decent work-life balance to the extent you have flexibility? And so there's lots of issues there. It's not any one solution, but it's really easy to get defeatist at this point in the business cycle over what's going on in the labor market. And I think it's really critical that firms recognize this is not going to go away. It's not going to go away in a month or a year. It's a longer term issue that's here with us. We know that because of demographics. And so it's going to be something that you're going to have to plan around. And if you can be better than the next guy, right, if you can overcome that attitude and make sure that you're doing everything that you can to attract and retain workers, that's a huge competitive advantage for your firm. All right, so let's get to MTI. So if you look at the industry right now, it is up 3.3% year over year. So that's most recent 12 months to 1 year ago. It's in phase B, which is the accelerating growth phase of the business cycle. So not only is that rate of change positive, but it is rising. And so there's more accelerating growth ahead. We're expecting that by the end of the year, we'll be seeing year-over-year growth of 10.5%. 2022, we'll see those growth rates come down. How do we know that? Because of those leading indicators. Again, 11 of those 12 key leading indicators are moving lower, signaling that we'll see that slowing growth in 2022. 2023, our outlook is pretty much flat, down 1.1%, a bit of decline in the middle part of the year, but then some rise a bit later in the year and into 2024. So really, you want to think of 2023 as the mildest of speed bumps. We're still going to be above where we are right now in terms of the annual data trend that's plotted off to the left-hand side of your screen. So again, you don't need to be scared of the future here. It's just planning for that speed bump. I would be remiss though if I didn't mention auto and heavy truck. Those two particular sectors, and we'll get to that in a moment, because of just how tangled the supply chain is for those two industries. If you have heavy exposure to that, you want to cut your expectations relative to what you see on this chart. If you have no exposure to those two sectors, you might even want to have more optimistic projections than shown on this chart. If you need help with that, we definitely offer services that where you can see, for example, our DataCast program. You can look at your business's rates of change relative to the key rates of change for the different industries and see what's moving your business. So we have a free trial of that if that's something you're interested in. And then let's take a look at some of the key vertical markets in your report. So construction machinery, 29.3% is the year-over-year growth we're going to have here for 2021. We will see flattening going on in 2022 and 2023, even a bit of decline. And the reason for that is we'll see that growth rates will be coming down, especially in single-family housing. And so that coupled with the deceleration in business-to-business spending, we'll see that soften up appreciably. Light vehicle, I mentioned, this is not where you want to be right now. Semiconductor shortages, we had to take down this forecast because of the lack of chips influencing how much can be produced. Demand is quite healthy, but unfortunately, we can't quite get out those cars to consumers. And so we're looking at a slightly negative year this year. Next year, a bit of a bounce back, 5.4% relative to a pretty depressed level here in 2021. It'll really take till 2023, we believe, and a number of industry pundits believe too, before we really start to see that chip shortage begin to resolve itself, and we'll get back toward a healthier level of activity here. If you're looking at heavy duty truck production, much the same story. We had to take down this forecast as well because of supply chain problems. A bit of decline here near term. Longer term, we're pretty bullish about heavy truck. There's certainly the demand for it. It's really a function of truck drivers. Can we get enough of them? But in terms of the need, it's absolutely there. Just truck drivers, and can we get those chips in and other parts that we need to make the trucks? Oil and gas, I mentioned this is going to be one of those few markets where we have a higher growth rate in 2022 than 2021. We've spent the vast majority of this year repairing balance sheets for these oil and gas firms. And so now with oil prices around $80 a barrel, comfortably above the cost of extraction, we're going to see some rise in extraction. We should see some rise as well in drilling activity. And so if you're heavy into this market, you'll see a better conditions there for 2022 than here in 2021. Medical equipment, this market is going to be generally rising. If you look at the expenditures for medical care right now, they are rising. So demand is certainly here. Right now, we're at a growth rate, 6.8% year over year, that is not quite sustainable. So we'll see some pullback in growth rates next couple of years. But overall, this is a rising market. And then civilian aircraft, this is really the same story as oil and gas in a way, right? 2020, early 2021, this was a very tough place to be because of the pandemic. But now we're seeing demand and travel return. And so some very healthy growth rates here for the next couple of years. That being said, we still have a long way to go to get back to where we were. And so this is a long-term recovery story. It's going to see some better growth rates, but as I said, we're still going to be below where we were for quite some time. Computers and electronics, this is a very good industry to be in. Relates very well to consumer demand. As I said earlier, very low delinquency rates for consumers, low debt levels, very strong consumer, lots of savings. That's going to help this market rise for at least the next 3 years. And so what are some things that you can do here as you sit in phase B, what we call accelerating growth, the best phase of the business cycle, where you have those rising growth rates, positive growth rates? Well, one is because of the leading indicator evidence being what it is, you want to avoid drawing that straight line with your revenues, because if you're doing really well this year, 2022, your growth rates are going to be quite the same that they are this year. And so we'll be seeing those growth rates turn over and seeing some softening next year. And so you just want to avoid being too optimistic at this point of the cycle, because it won't be around come 2022. Some other things you want to make sure, definitely hiring and training and retention, as I mentioned earlier, that you need to have the people and equipment you need to meet that general rise in the economy for at least 2024. And so definitely a time where you kind of have to balance that, avoiding being overly optimistic without thinking that there's a recession right around the corner. As you think about 2022, though, you'll have to recognize that it's just simply not possible for most of you to be able to make the same growth rates, meet the same growth rates in 2022, 2023 that you have had here in 2021. And so you'll just have to make sure that that takes into account that reality when you're talking to your sales and marketing team. Also, some other things to consider is just making sure that you're revisiting those capital expenditure plans and making sure that you're not assuming that linear, robust rise in activity. So with that being said, I will take a pause here and open it up to any questions that you all have.